Assalamualaikum warahmatullahi wabarakatuh.
What is the definition of national income? National income is the amount of income received by all family households, RDK, in a country from the delivery of production factors in one period, usually for 1 year, which is calculated using units of money. Approach to calculating national income. Approach method, summing up the added value of all sectors for one period. This added value is obtained from the difference between production value, output value, and cost value, input value, in each production sector. International Standards Industrial Classification, ISIC, classifies the Indonesian economy into 3 sectors. A. Primary sector, agriculture, animal husbandry, forestry, fisheries, mining, and quarrying. B. Secondary sector, industry, processing, electricity, water, and gas. C. Tertiary sector, trade, hotel, restaurant, transportation, telecommunications. Formula: I equals P1xQ1 plus P2xQ2 plus PNxQN. Y equals national approach. P1 equals price of the first item. Q1 equals number of goods. 1 PN equals price of goods to N. QN equals number of items, N. It's known that the data on the price of goods and the amount produced in the ABC country in 2016 as follow. Price quantity cotton Rp 5,002 unit logs Rp 10.0003 unit needle Rp 25.0004 unit cloth Rp 43.0002 unit. Calculate how much the national income of the country using the production approach. Answer: Y equals Q1xP1 plus Q2xP2 plus Q3xP3 plus Q4xP4. Y equals 2xRP 5,000 plus 3xRP 10.000 plus 4xRP 25.000 plus 2xRP 43.000. Y equals Rp 10.000 plus Rp 30.000 plus Rp 100.000 plus 2. Approach using the income method, summing up the income from various production factors that contribute to the production process. The factors of production include labor, capital, land, and expertise/entrepreneurship. Reciprocity, income from the four factors of production. A. Labor equals GT, salary/wages, wages. W. B. Land equals GT, rent, rent. R. C. Capital equals GT, capital interest, interest. I. D. Skills/entrepreneurship equals GT, profit, profit. P. Formula. Y equals R plus W plus I plus P. Y equals national income. R equals income from wages/salaries and others. W equals net income from rent. I equals income from interest. P equals income from profits of companies and individual businesses. It is known that economic data from a country is as follow: rent land, R, Rp. 300 trillion. Wages, W, Rp 2,500 trillion. Capital interest, I, Rp 500 trillion. Operating profit, P, Rp 400 trillion. Calculate the national income of the country using the income approach. Answer: Y equals R plus W plus I plus P. Y equals Rp. 300 trillion plus Rp. 2,500 trillion plus Rp. 500 trillion plus Rp. 400 trillion. Y equals Rp. 3.700 trillion. Three. Approach with expenditure method. Summing up all expenditures of various economic sectors, namely, households, governments, companies, and people from abroad in a certain period. Components needed for calculations with the expenditure approach method. A. Households with type of expenditure for consumption, C. B. Company with type of expenditure for investment, I. C. Government by type of It's known that the data economics Y equals C plus I plus G, X, M, Y equals RP. 253 trial I un plus RP 75 milliard. And we go to the next material. There is nature of national income calculation. Income approaches. The calculation is done by adding up all income starting from wages, rent, interest, to the profit received by consumption households in a country in a certain period. This is in return for the factors of production given to the company. Production approach is how to calculate. It is done by adding up the entire value of the product in the form of services or finished goods produced. So what is the benefits of calculation of national income? Benefits of calculation of national income is knowing the level of prosperity of a country, evaluating the performance of the economy on a certain scale, as an indicator of the comparison of the quality of living standards between countries, as an indicator and comparison of the level of economic growth from time to time, as an indicator and comparison of economic growth and wealth of a country. Makes it easy to compare the economic performance of each sector. GDP, also known as gross domestic product, GDP, is a monetary measure of the overall market value of products, in the form of goods and services, produced by production units within a country during a year. The formula of GDP is domestic citizen income plus domestic foreigner income. GNP, which is also known as gross national product. GNP is the total market value of products, in the form of goods and services, produced by citizens both at home and abroad in 1 year. The formula of GNP equals income of domestic citizens plus income of foreign citizens. Net National Product or NNP. NNP is the value of GNP when it has been deducted by depreciation and repairs of capital goods. National income in the form of NNP sees national income only based on the amount of profit, or in other words net profit from a production activity. The following formula is used in calculating NNP. GNP minus depreciation. Net national income or NNI. NNI is the value of NNP when it has been deducted by indirect taxes and added to subsidies. The value of NNI is national income, which looks at national income in terms of the rewards obtained by the owner from various production factors. The following formula is used in calculating NNI. NNP minus indirect taxes plus subsidies. Personal income or PI. PI is the value of NNI when it has been deducted by social funds, corporate taxes, retained earnings, and has been added to the transfer payment from the government transfer payment. PI is the value of national income received by consumers or households in an economy. Here's the formula for calculating PI. NNI plus services and goods, or can be used as an addition to savings and later become capital for investment. The amount of DI value is the PI value when it has been deducted by direct tax/personal tax. The following formula is used to calculate DI. PI minus direct tax. Example of calculation problem. If it is known that the income of foreign nationals to the country is Rp. 80 million, the income of foreign citizens in the country is Rp. 20 million, the income of foreign citizens abroad is Rp. 50 million, the income of foreign citizens abroad is Rp. 30 million, indirect taxes Rp. 3 million, depreciation of Rp. 5 million, social funds of Rp. 2 million, retained earnings of Rp. 10 million, corporate tax of Rp. 15 million, transfers from the government of Rp. 4 million, indirect taxes of 7 million Indonesian rupiahs. Calculate the size of GDP, GNP, NNP, PI, and DI. Answer. A. GDP equals IDR 80 million plus 20 million Indonesian rupiahs equals 100 million Indonesian rupiahs. B. GNP equals 100 million Indonesian rupiahs minus 20 million Indonesian rupiahs plus 30 million Indonesian rupiahs equals 110 million Indonesian rupiahs. C. NNP equals 110 million Indonesian rupiahs minus 5 million Indonesian rupiahs equals 105 million Indonesian rupiahs. Answer. D. NNI equals 105 million Indonesian rupiahs minus 3 million Indonesian rupiahs equals 102 million Indonesian rupiahs. E. PI equals Rp 102 million minus Rp 2 million minus Rp 10 million minus Rp 15 million plus Rp 4 million equals Rp 79 million. F. PI equals 79 million Indonesian rupiahs minus 7 million Indonesian rupiahs equals 72 million Indonesian rupiahs. Nominal GDP. Measuring the value of output in a certain period of time based on market prices or prices prevailing in that period, current price. For example, to measure 2001 GDP, the benchmark price in 2001 is used, while for 2017 GDP, the price prevailing in 2017 is used. Nominal GDP is calculated by multiplying the amount of output by the market price output, or nominal GDP equals PXQ. Real GDP. Real GDP is measure the output value of a certain period based on the base price or constant price. Real GDP calculates GDP by multiplying the quantity of output by the price, which is constant, meaning that it does not use the prevailing market price at that year. This constant value can be determined using one base year in which the price is used as a reference. GDP deflator. The GDP price deflator, also known as the GDP deflator or the implicit price deflator, measures the changes in prices for all of the goods and services produced in an economy. Gross domestic product, GDP, represents the total output of goods and services. However, as GDP rises and falls, the metric doesn't factor the impact of inflation or rising prices into its results. GDP price deflator shows how much a change in GDP relies on changes in the price level. It expresses the extent of price level changes, or inflation, within the economy by tracking the prices paid by businesses, the government, and consumers. GDP price deflator calculation. The formula is that the GDP deflator is equal to nominal GDP divided by real GDP and multiplied by 100. Example. In 2001 nominal GDP, the output is 1 lot of meat at a price per lot of $20 and 1 lot of rice at a price per lot of $10. Total 2001 nominal GDP was $30. At the 2017 nominal GP, the output is 2 lots of meat at a price per lot of $30 and 2 lots of rice at a price of $15 per lot. Total GDP nominal 2017 is $90. Prices prevailing in 2001 are used as the basis for calculating real GDP 2017. The calculation of real GDP 2017 is a calculation of output in the current year with base year prices, so the calculation is 2 lots of meat at a price per lot of $20 and rice 2 lots at a price per lot of $10. Total real GDP 2017 is $60. GDP deflator equals 2017 nominal GDP per 2017 real GDP, multiplied by 100 equals $90 per $60, multiplied by 100 equals 150. There was an increase in output prices in general by 50% in the period 2001 to 2017. Benefits of the GDP price deflator. First, using the GDP price deflator helps economists compare the levels of real economic activity from one year to another. Second, the GDP price deflator helps identify how much prices have inflated over a specific time period. GDP deflator versus CPI, Consumer Price Index. The difference between the two are: first, GDP deflator measuring the price of all goods and services, while CPI only measures the price of all goods and services purchased by consumers. Second, the GDP deflator only covers goods and production produced by domestic, while the CPI includes all goods and services purchased, exports/imports. Third, the GDP deflator uses a non-fixed scale while the CPI uses fixed scales on different items. Per capita income. Per capita income is a parameter related to the level of welfare and prosperity in a country, because its value is obtained from the average income of the people residing in the country. With this calculation, we can find out the level of welfare of the average population in a country. Per capita income formula. Per capita income in a country can be calculated in two ways. The first is based on the prevailing price, or commonly referred to as nominal income. Second, it is calculated based on constant prices or fixed prices taken as the reference year, or referred to as real income. That means, per capita income can be obtained by dividing national income by the number of people living in a country, or can be obtained by dividing real income by the number of people living in a country. Example. First, involve GNP based on prices that are currently in effect. If the GNP figure in Zimbabwe in 2019 is 1,300,567,000 with a total population of 262 million in the same year, then the calculation formula is as PCI equals nominal GNP per total population. So, the PCI value in Zimbabwe is 1,300,567,000 per 262.000,000 equals 0.0049639961832061 or 4,963.996. Second, involve real GNP. If in Zimbabwe the GNP in 2010 was 400 billion, and the GNP figure in 2019 was 1,300,567,000 with a total population of 262 million. Then based on fixed prices, the PCI formula is K to P equals constant GNP per total population. So, it can be seen that the value of GNP in Zimbabwe is PCI equals 400 billion per 262 million equals 0.0015267175572519 or 1,526,717. From these data, we can conclude that the nominal PCI in Zimbabwe. Benefits of calculating per capita income. First, knowing the level of prosperity of a country. Second, knowing the results of a series of economic activities of a country for 1 year. Third, the basis for consideration for the government in formulating policies to encourage the rate of growth and economic development. Fourth, measure the current inflation rate. National income is the total income of all family households or RTK in a country, in a certain period, which is usually 1 year. Expenditure method is to add up the components of household spending, government spending, and investment. Income method, namely adding up rental income, wages, interest, and profits. The following are some of the benefits of calculating national income. Realization of state revenues reached Rp 886.9 trillion in the first semester of 2021. This achievement rose 9.4% from the same period in the previous year, which recorded a realization of Rp 810.7 trillion. The second highest growth came from non-taxed state revenues, PNBP. Realization of PNBP amounted to Rp 206.9 trillion, up 11.4% from 185.7 trillion in the first semester of 2020. Lastly, the realization of tax revenues amounted to Rp 557.8 trillion. This tax revenue achievement rose 4.9% from the first semester of 2020, which amounted to Rp 531.8 trillion. The structure of the Indonesian economy. Have two kind of structure. 1 agrarian structure. 2 industry structure. Agrarian structure is an economic structure dominated by the agricultural sector. The agricultural sector is the source of livelihood for the majority of the population. Industry, where the economic structure is dominated by the industrial sector. Most of the domestic product was contributed and the pace of economic growth that remained was contributed by the industrial sector. Indonesia's economic structure viewed from various viewpoints. 1. Macro-sectoral overview. 2. Spatial overview. 3. Overview of state administration. 4. Overview of decision-making bureaucracy. Based on a macro-sectoral view, an economy can have an agrarian, industrial, or commercial structure. Based on the spatial analysis, the economy can be stated as having a rural/traditional structure and an urban/modern structure. Based on a review of state administration, it becomes an economy with an ethical, egalitarian, or bourgeois structure. It depends on who/which groups are the main roles in the economy concerned. based on a review of the decision-making bureaucracy, it can be distinguished between a centralized and decentralized economic structure. The spatial structure of Indonesia's economy in the third quarter of 2020 is still dominated by the provincial group on the island of Java, with a contribution of 58.88%. Unfortunately, the island of Java is still experiencing negative growth. The other islands also experienced negative growth in the third quarter of 2020. In fact, the islands of Maluku and Papua, which in the second quarter of 2020 were still able to grow positively in the midst of the COVID-19 storm. Thank you for watching our material video. If we have any wrong words, please forgive us. Goodbye, see you.